Hello, good morning. Well, that was a tough act to follow, but she previewed some of the things that we're going to cover in our climate panel today. When people talk about climate, it's a very broad issue, but we hope to focus it today specifically on climate-related financial risk and how financial institutions and regulators are approaching this risk. Thank you to our three panelists today. We have a fantastic lineup. First, we have Jonathan Fink, who's the Assistant Chief Counsel and Acting Climate Risk Officer at the Office of Comptroller of the Currency. Jonathan has a distinguished career with the OCC, serving in various roles that span more than 25 years. In his climate risk role, Jonathan leads the agency's climate risk efforts related to supervision, policy, and external engagement. Next, we have Alison Hashmall, counsel at Debevoise and Plimpton, and a member of the firm's financial institutions, banking, and fintech groups. She advises financial institutions, non-financial firms, and trade associations on bank regulatory issues, including with respect to climate-related financial risk and disclosures of such risk. And finally, we have Mary Obasi, who is head of global climate risk at Bank of America. Mary leads an enterprise-wide climate risk management program that advances the use of climate risk factors to enhance the firm's preparedness towards climate-related financial risk. And she has received the Sustainability and Climate Risk Certification by the Global Association of Risk Professionals. And I'm Tiffany Haas, your moderator and co-ed of Government Affairs at the Financial Services Forum. So first I want to level set with the panel and first define just what is climate-related financial risk. And I'll start with you, Mary. When we talk about climate-related financial risk, we often talk about it in two buckets, the physical risk and transition risk. Could you speak a little bit about both of those and how Bank of America is approaching both of those risks?
Sure. And first, just glad to be with all of you this morning. Glad to spend some time talking about climate risk. Usually when you think of climate risk, we divide it into two main buckets. The first is probably the one that is talked about the most, right? So when you think of transition risk, we're really talking about what are all the implications of all the commitments that have been made to essentially achieve net zero, right? And so if you just consider for a second, at this point, you have 90% of the world GDP that's covered by a net zero commitment. You have, and that probably covers, I think, like 80% or so of emissions. And on an annual basis, it covers 85% or so of the world's population. So that's a quite significant commitment that's been made across world economies by large corporations to achieve net zero. And if you think about, again, what are all the sources of emissions, like what does that actually mean? You're really looking at, again, pretty much the foundations and the infrastructure of how we all live. It's everything from how we power our businesses and our homes. It's from what we eat. It touches upon how we get to and from different places, right? Travel, transportation. And it touches upon even what buildings are made out of, right? If you think of steel and cement. So it actually has a very far-reaching implication across the various industries and sectors in terms of what actually that commitment translates into. So that's the transition risk that we're talking about. And then when you look at physical risks, we break them out into two categories. One is sort of the acute weather events, and those will be most familiar to all of us, right? Whether it's the hurricanes that you see, whether it's flooding, whether it's wildfire. Those are the types of perils or hazards that we look at and think of when we think about physical risk. And obviously those can lead to lots of different types of risk, right? We see, rising insurance costs, or in certain cases, insurers pulling out. We have to think about, what are the implications for how buildings are even being made, right? So there's a lot of risk implications there. And then there's the more, what we think of as chronic physical risk, which are things related to, again, just if you think of like sea level rising over time, right? You can follow sort of what's happening, for example, in the Antarctica. And then we also think of, again, just really changing and unexpected temperatures in different locations. I think Nellie was mentioning the heat wave right now in the UK, right? So again, and think of what happened in Texas with the deep freeze, right? So again, that's what the climate science is telling us we will start to see over time, right? If emissions aren't curbed, and so those are the other types of risks that we look at.
Great, thanks. And I want to get circle back with you and talk a little bit more about how the bank is approaching those different types of risks and which ones seem to be the most acute for you all. But I want to turn it to Jonathan next. And from a regulator perspective, what are your observations about the nature of this risk, and how are you seeing it manifest in large financial institutions?
Yeah, thanks so much, Tiffany. And as Mary said, it's great to be here, seeing many familiar faces again. So I think Mary captured very well the physical and transition risks that the literature sets forth and that we talk about in this area. Maybe I can start out with some initial observations about the OCC's role. As many of you know, we're a prudential supervisor, so we're all about risk management. Unlike some of our counterparts in other parts of the world, whose mission is broader and might include aspects of the underlying transition, the OCC's focus is targeted, and it's, I like to say we have three priorities: risk management, and risk management. So it's quite targeted, and stems from the fact that with respect to the risks that Mary described, if banks were not to identify, measure, and mitigate those risks in an appropriate way, it would impact the safety and soundness of the institution. So right bang core in the OCC's safety and soundness mission. I shared with Mary the observation of the distinction between acute and chronic physical risk. I think we're all going back many years, used to addressing acute risk. We've all seen acute weather, and banks of all sizes throughout the country and the different regions of the country have been used to addressing that and the disaster recovery preparedness and so forth. It's the chronic weather change that we're now addressing and seeing that's a different dimension, and that can be a risk to the prudential safety and soundness of financial institutions, which is why regulators worldwide are paying attention to it. We'll talk a little bit later, Tiffany, about the OCC's, I think, about the OCC's guidance that we issued on risk management. But I mean, the good news is that was our approach is intended to support the work that large banks are already doing because of the business imperatives that underlie these risks. Banks are not thinking about this as a compliance exercise or as a regulatory exercise, although it has that dimension, but rather as a business imperative. And so our approach has been to support the risk management professionals like Mary and others in the banks who are focusing on this risk and helping their senior management and board members focus as well.
Right. Alison, you have so much experience working with large financial institutions. How are these institutions defining this risk, and what are some of the most pressing of these risks?
So I think financial institutions are pretty much defining it consistent with what Mary and Jonathan just said. As you set it out, there's physical risk and transition risk, and then kind of sub-risks within those. I think, each institution might define it a little bit differently or subcategorize those a little bit differently depending on how they approach the risk. And there's actually a nice summary in the FSOC report that was referenced earlier where they kind of categorize different types of, extreme weather events, sea level rising, other types of physical risk. Transition risk could be public policy changes. It could be the risk of moving to a new type of technology and how that could disrupt existing businesses. So, and this goes to one of the core points, I think will be a theme throughout my comments, which is that in terms of how how institutions define risk and how pressing they are, it really can also depend upon the particular financial institution. So, different institutions of different size and scope will have different geographic footprints, different asset portfolios, and therefore different exposure to these types of risks. So those could really depend on the type of institution. In terms of what's pressing, I think we'll talk more about risk management, but from a physical risk perspective, some of these are fairly familiar to banks, and they've been dealing with these risks for some time now and are already addressing them. To give an example, with respect to extreme weather events, banks will generally have policies in place to require flood insurance when underwriting a mortgage that's a commercial or real estate property that's in a floodplain. So I think some of these risks, like you mentioned, it might be the chronic that's a little bit newer and tougher than the acute extreme weather events, which I think banks have already been dealing with. There was this New York Fed report that came out in January, I believe, or November, and it was updated, noting that banks have been pretty good at actually addressing extreme weather events, and in particular found that large banks were, I think they said, barely affected by extreme weather events, partly due to the geographic diversity of the institutions. Transition risk is a bit tougher, I think, because there's a lot of uncertainty about what policies will actually come to fruition, how technologies will develop and change, and how those will impact industries. So I think not necessarily more pressing as a risk, but harder to forecast and address.
That was a great overview of defining the risk. I want to transition a little bit to how these large institutions and regulators are approaching climate-related financial risk and identifying, assessing, and managing it. I'll start with Jonathan. The OCC put out its guidance for large bank risk management of climate-related financial risk at the very end of last year, with a comment period that closed in February. Could you provide an overview of the work that the OCC is doing in this space, the goals that you all have, and really if you could provide a little bit of insight of how you're working with large financial institutions to better understand not only the types of risks, but also the level of these risks?
Yeah, sure, Tiffany. So I sort of tried to set the stage with my earlier remarks about how this is core to the OCC's mission. And that has us sort of working in this area in a number of different ways. So we have our policy development group at the agency that has worked on the high-level risk management principles that I mentioned earlier, applicable to banks of 100 billion in assets and greater. Those really are consistent with principles issued by the Basel Task Force on Climate Risk and other jurisdictions. So there's a sort of a policy development piece to our work in this area. A critical part of our work is simply engaging with other regulators domestically and internationally and other stakeholders. This is an area that is new to risk management, reasonably new. There are lots of developing approaches. I think we'll talk about some of those later. And we learn a lot by talking to our neighbors and our friends and our counterparts, including jurisdictions that began this work just a little bit earlier than we did in the US. So there's a lot to learn there from engagement. I see that happening in the private sector side as well, including banks that have had the benefit of looking at regulatory approaches in other jurisdictions as part of their organization. And then, as you anticipated, I think, Tiffany, as well, the OCC is a boots-on-the-ground supervisor. Most of our employees are bank examiners out in the banks, working from our field offices, and some of them resident in the larger banks. And so a part of our work, of course, is engagement with the banks directly. We have many people in this audience, of course, know this. We have each bank has its own OCC large bank team. So we're working with those teams. We've got a group in Washington, an Office of Climate Risk, that works with senior policy and other officials in Washington, and through them with the large bank teams to integrate climate-related financial risk into our supervisory strategies. We mentioned that, I think, in our recent semi-annual risk perspective. And so later this year, we'll be continuing to engage with the banks in discovery reviews. We had earlier, I think we also mentioned this in the semi-annual risk perspective, we had earlier done a range of practice survey of the largest banks to get a baseline understanding of where banks are structurally in governance and otherwise with respect to this risk. And then we'll be following up that survey work with the discovery reviews in the large banks. So I would say, policy development, engagement, examination. There are other aspects to our program as well. A lot of internal work within the agency of making sure we've got the right infrastructure. I myself am the acting climate risk officer, as Tiffany mentioned, and will be filling that position permanently as well. And this is a priority of the acting controllers. He made that clear when he first came to the agency, and so we're really focusing on this risk. As I said earlier, so are the banks. I think the banks have really stepped up and are focusing on this. So I think there's a lot of collaboration as we learn this nascent risk management area.
Great. Alison, in your work with large financial institutions, they've been very proactive in identifying and assessing and managing this risk. Could you talk a little bit more about the existing tools that large banks have to manage this risk? And if you could also touch on, we touched a little bit on scenario analysis, but also the voluntary disclosure work that these large financial institutions are already doing.
Sure. So I agree with what Jonathan was saying. I think the large banks are taking this very seriously and have really devoted a lot of time and effort to building their risk management capabilities in the climate space. And we see that with our clients, upskilling their teams, hiring people, looking to better develop their models and risk management frameworks. And that's kind of whether it's incorporating climate risk into their existing practices and frameworks, or sometimes developing new frameworks and practices specifically to address climate risk. And as Nellie mentioned earlier, one of the core risk management tools that banks that they're using is scenario analysis. And that's really a way to look at the way I've been seeing it used is not necessarily to review the entire organization all at once, but to look at a subset of an asset portfolio within the institution, maybe a particularly vulnerable one, and to create different scenarios that could be either vulnerability to some sort of transition risk, physical risk, or a combination of both risks, and then to project over long time horizons, much longer than what would be typical for a bank from a strategy planning or risk assessment perspective because, as we've been talking about, some of these climate risks will materialize over a long period of time. So it's taking that snapshot and then projecting out into the future. And I'll talk more a little bit later about some of the challenges that we're seeing already and so far with taking that approach. I'd say beyond risk management, there's also quite a bit of governance developments and going on within large banks in order to make sure that they have the right people overseeing climate risk and strategy within the organization that may, again, it differs by institution. It could be creating certain new governance committees, whether board or management committees within the organization to oversee climate risk, or making sure that existing boards and committees within the institution are addressing and considering that risk. To your point about disclosure, many of the large institutions are voluntarily complying with certain disclosure regimes. One particular one, the Task Force on Climate-Related Financial Disclosures, or TCFD for short. And you can look, these are public, and they've really spent quite a bit of time disclosing, not only their exposure to different types of physical and transition risk, but also in those documents, the institutions will talk a little bit about what kind of risk management they're putting in place and other changes within the organization to address climate risk.
Mary, I want to dig deeper a little bit into scenario analysis, because it's such an important tool that large financial institutions are utilizing now to assess both physical and transition risk. I wonder if you could speak a little bit more specifically about what Bank of America is doing and provide some examples of the scenarios that you are using and kind of what you're learning from the exploratory scenarios that you've done already.
Sure. So maybe to talk about it, I'll take a step back and just sort of give some background to what Bank of America has done in this space overall. So first off, our CEO has set a net zero target for us across our operations, our supply chain, as well as the financing we provide to our clients, and we're looking to achieve that by 2050. We're setting some interim targets, and so we've set out some targets for energy, power, and auto, and what we hope to achieve with respect to the clients that we serve in those sectors by 2030. In addition to that, we've also set a target to mobilize $1.5 trillion in sustainable finance by 2030, and with $1 trillion of that focused on environmental finance. And so if you think about that, one of the things when we think about risk management, one of the things that's very helpful is to understand, really what the North Star is for our company, right? And what are the things that we've committed to doing, which is described quantitatively in those goals, but at the core of that is really walking with our clients as they transition to a net zero economy. And managing risk well is kind of a key consideration as part of that. And so to manage risk well, what does that involve? First, it involves, as Jonathan and Alison talked about, just understanding the risk and being able to identify it. And then with scenario analysis, I think it's such a critical tool as part of that, because we use it as a tool to just really explore just a range of different possibilities of what we could see as we're trying to execute on our strategy. And so what are some of the things that we found really helpful in leveraging that tool? Well, first of all, the work that various central banks have done as part of the network for greening the financial system has been just incredibly helpful to us, where they've laid out a number of different scenarios. They've basically taken the IEA, International Energy Agency scenarios and kind of tried to put in much more data, kind of going much more precisely in terms of specific variables that are useful inputs into our financial model. So we've been able to take those scenarios, as Alison talked about, they look at it across a couple of different ways that this transition could happen or not happen at all, right? So you have kind of a hothouse scenario, which is the one where essentially we don't transition and sort of kind of the worst comes to pass in terms of physical risks. You have a scenario that is the orderly transition, where everybody essentially fulfills their commitments on the schedule they've said they're going to fulfill those commitments. And so you really do see us achieve net zero as a world in a kind of a pretty orderly way. And then you have the disorderly transition, which kind of then we still get to net zero, but it's sort of in fits and starts. And so if you think of those scenarios and you think of, again, just the range of how it will impact different industries in many different ways, it's really helpful for us to look at whether it's our lending portfolio or even from a shorter term perspective, You could think of, what happens if we see some of the disruption that we've even seen most recently, right, relative to the price of oil and sort of an energy crisis playing out. And what does that mean for our clients? What does that mean in terms of how we need to serve them, right? So those are the sorts of things we explore. In the hothouse scenario, that's where we're really exploring, well, what happens if we start to see much more severe, much more frequent weather events impacting, again, different geographies, different industries in different ways. And then again, how do we make sure that we are taking steps now to start to be more resilient to what could happen? And how do we make sure we're able to, again, support our clients in what they might face as these risks start to play out? And so we found scenario analysis to be a really, really helpful tool, because it's really just about exploring all of the different possibilities that could happen and how they might play out, and using it across our institution just to work with business leaders to say, well, what would you do if this happened? What are some of the levers you might have? So that's how we've been using it.
That's a really helpful overview. And you talked a little bit about what you're learning. And this question is for all three of you, but I'll start with Mary as a follow-on. This is such a new area still, even though the large financial institutions are being very proactive and moving forward. What are some of the challenges that you are seeing now that you've conducted some of these scenarios? What are some of the gaps that you see still need to be filled to improve really the data that you're seeing at the end of all of these scenarios?
Yeah, I mean, definitely, it'll probably be something that's echoed a lot. This is a very data-hungry, data-rich kind of exercise to do. Because you really are looking at differentiated outcomes by geography, you're looking at differentiated outcomes by industry and sector. And so that does require going fairly deep into the data and collecting it and understanding it and standardizing it so that it can be consumed by our financial models. And then you can have a sense of, okay, what could be the implications of if this came to pass. So that's definitely one of the lessons. The other two, I guess I would call out, is one is just this challenge around time horizons, and it is again, if you think of our kind of the strategic planning window is again in that 3 to 5 year kind of period, and even longer. You think of the lending we do and the sort of the tenor profile of those loans. I mean, 2050 is a very kind of long time to really consider. So all of those things are areas where we have to go deeply and sort of think about what is this telling us that we need to do today based on these things that are potentially many decades out. And then maybe thirdly, I would just call out is, again, a lot of times when we do scenario analysis, a lot of the kind of key indicators we usually look at, macroeconomic factors, right? What's happening with GDP? What's happening with unemployment rates? What's happening with the home price index? With this kind of risk, those are helpful indicators, but like I said, you almost have to be able to say, for this specific sector, this specific geography, what's happening with all of those three factors. And so again, kind of connects back to this point around data. But yeah, it's still definitely a lot more work to do in this emerging space.
Jonathan, from a regulator perspective, you're kind of on a similar track, but on the other side of things, what are you finding? Is it similar challenges? Anything in addition that you're finding that's difficult, and the gaps that need to be filled to really improve this space?
Yeah, thanks, Tiffany. Mary really captured this area very well, and our experience of what we're seeing in the banks is very consistent with that. One thing that the acting controller has noted with respect to scenario analysis is, it can be sort of top down or bottom up. So the top down is where you sort of we've got these data gaps, and we've got these challenges around the long-term nature of the risk and the fact that we don't have the historical precedent information that we do when we're doing other kinds of stress tests. But the bottom up that he mentioned in his November 2021 speech is a sort of small s scenario analysis, just sort of the what if question at its most basic level. And the acting controller has analogized to geopolitical risk in this regard. Banks that ahead of a geopolitical event ask themselves, what if there were disruption in this region of the world? what would my portfolio look like. Those who do that earlier rather than later are probably placed in a better position than if they don't do that kind of what if questioning. So I think there are a lot of challenges. I think we're all working on that both in the private sector and the official sector. Data will improve the granularity of it and how we understand the IAMs and how we work through the complicated modeling issues. But we shouldn't make the perfect be the enemy of the good. There's a lot of basic blocking and tackling kind of work that can be done, we think, ahead of that, the small s scenario analysis planning that the acting controller referred to in his speech. And we see that happening. This is not an area, I think, most people think this is not an area where we serve ourselves well by awaiting perfection. In fact, as Nelly also said earlier, by grappling with the imperfect data, we're better able to identify that which we don't know, that which we need to know, and that will help us iterate to a better solution.
Alison, anything to add from what your clients are seeing?
I think this has been pretty well captured, so I won't say too much more other than just to add a few points. One, I think the lack of complete data or fully reliable data just suggests the need for some, that this will be an ongoing iterative process, and it may take some time for this to develop into kind of a standard practice or a set of expectations as the data and as well as modeling capabilities to continue to grow. So I think it'll be an ongoing dialogue, between the financial institutions and the regulators. And then on the time horizons point, that sort of compounds the issue with the data and the methodologies to some extent, because it really relies on assumptions that it's critical that you get right, especially as you project out, decades into the future, and the results of that can be, will be compounded. So I think in some sense, the time horizon issue is a bit of an inherent challenge with scenario analysis.
Great. And in the U.S., regulators have really made this distinction between scenario analysis and stress testing. And we even heard it with Undersecretary Lang earlier, making this distinction. We've heard it at the Fed as well. Alison, why do you think this distinction has been made at this point, and why capital has not been decided that that's the appropriate tool at this point?
Yeah, no, that's a great question, and I know Nelly addressed it a little bit earlier. I think of it right now, scenario analysis, as fundamentally a different tool than stress testing. It's really about exploring, different potential outcomes and being used to assess the capabilities and risks. It's kind of a risk management tool as opposed to stress testing, which is, to assess capital adequacy, and importantly, can have regulatory consequences attached to it. I think in addition to scenario analysis being kind of fundamentally different, it's also, for all the reasons we've been talking about, which, incipient data, developing methodologies, it just doesn't seem at this point in time, at least, appropriate for that to be used in a way that could lead to regulatory consequences. But really, it's meant to be a tool to help banks assess their risk and vulnerabilities.
Jonathan, I know that the OCC has made comments on this as well, so I want to give you an opportunity to weigh in on this.
Yeah, thanks, Tiffany. Consistent with what Alison was saying, in the risk management principles that we issued for comment in December, we did distinguish in the way that Alison noted and Nelly foreshadowed between scenario analysis as a risk management tool and the stress testing that grew out of the SCAP, and that was looking at transitory shocks and their impact on the economic climate with a view to, thinking about capital adequacy. That's not the context in which we've been talking about scenario analysis in this context.
Transitioning a little bit, and we started talking about it with Alison saying that this is really a risk management tool. And I want to talk about how this fits into the broader risk management framework, and I'll start with you, Jonathan. Do you view this climate-related financial risk as something that's separate and distinct, or should it be kind of folded into the broader risk management framework? And if so, why or why not?
Yeah. So thanks, Tiffany. So I think the prevailing view is that the physical and transition risks that we've all been talking about are drivers of the familiar risk stripes that we list and address in our guidance, for example, of credit risk, operational risk, market risk, and so forth, rather than being sui generis risks. That's the approach taken by most risk management and other prudential regulatory stakeholders, and I think that makes sense. I will say that we think that it does not make sense for regulators to be overly prescriptive in how frameworks are designed, because often a corollary question is, does that mean we should have an integrated framework rather than a standalone framework? It may lead one to that conclusion, and I think many banks are taking their existing frameworks and integrating climate into that. But we haven't been prescriptive with exactly, and precisely how you design and construct the framework. Of course, the large banks are already subject to a requirement to have those risk management frameworks. They're subject to the OCC's heightened standards, and then also our corporate governance and other related requirements that we flesh out in our Controller's Handbook. But going back to my earlier comment to an earlier question regarding the way in which our large bank supervision teams in each individual bank are the way in which we engage with the banks, it'll be a very tailored kind of approach rather than a prescriptive approach from Washington in terms of how a framework needs to be precisely constructed. But again, I think we're seeing that, and I'll be interested in Mary's comments on this. We're seeing that generally banks want to sort of take their existing framework and adapt it and integrate climate-related financial risk into that framework.
Mary, to you, what do you think? Should it be part of the already existing framework or outside that?
Yeah, well, I mean, to Jonathan's point, I mean, that's essentially the approach we've taken is to embed it into our existing risk management framework. And so just for us, what does that really mean? So the financial risks we care for, right, are the ones I think many are familiar with, right? We look at credit, market, liquidity risks. We also look at our non-financial risks, compliance, operational, reputational, and strategic. And so in all of those, you can see different flavors of how climate risks that we're talking about could impact all of those risk types and risk areas. So just start with credit risk. One of the things we spend a lot of time thinking about is, particularly relative to physical risk, in certain areas that have been subject to, we'll say, like wildfire risk or repeated hurricanes, you have started to see changes in the insurance industry, either with premiums going up quite a bit or frankly, insurers starting to pull back out. And so what does that mean in terms of, consumers' ability to repay, right? So those are the ways in which we start to think of the interaction within credit risk. For our commercial clients, right, particularly those industries that have a lot to do to transition to a lower carbon economy, that does take capital and that does take financing and may in certain cases require them to diversify from their traditional business. So they're going to have to place some bets. And so that also changes their financial profile. And that's how we have to start to think about what are the implications from a credit risk perspective. But just to also illustrate, even on the non-financial risk side, there's obviously been quite a bit out there in terms of, are there consistent definitions in terms of what counts as environmental finance or ESG, right? These very broad terms. And so there is risk there, right? There's risk that again, as institutions are developing their own taxonomy in where there isn't a kind of a, we'll just say, industry standard taxonomy, that could be confusing, right, for our customers and our clients. And so how do you make that clear? How do you provide clear and transparent disclosure in terms of what you're offering, right? And so again, it's flavors of existing risk, but that, again, we just have to think about in the context of how we manage climate-related risks.
We only have a few minutes left, so I want to make sure we get to something that was previewed in a prior panel, and that was a big development out of the Supreme Court recently with the West Virginia versus EPA case, which very briefly limited the EPA's authority with respect to greenhouse gas emissions at power plants. And so there was a little bit of discussion about how this could have impact on policy going forward. And Alison, we also have another great legal expert with us, and so curious your thoughts on how this could impact policy, particularly climate-related policy moving forward.
Sure. So, and just to recap for those who may not have been here for the earlier panel, essentially, the Supreme Court struck down an EPA rule that had regulated greenhouse gas emissions from power plants under this so-called major questions doctrine, and which essentially says that there needs to be clear congressional authorization for actions that are deemed to be of economic or political significance. And I agree with what the earlier panelists said about potential application of this doctrine, even though it's meant to be in extraordinary circumstances, to other regulations, and maybe even particularly climate-related regulations by financial regulators. And it's interesting that the opinion itself doesn't go into much description of how this could be applied to future cases, but Justice Gorsuch wrote a concurrence that does, and kind of talks a little bit about how this doctrine might apply in other situations. And one particular factor he highlighted struck me, which was looking towards when the agency has no comparable expertise on policy judgments in this area, maybe there's no, they weren't authorized to make regulations in this space. So at a very high level, I think that concept could potentially apply to financial regulators in regulating in the climate space. That being said, as Jonathan's been talking about, I think a lot of the action we've been seeing, particularly from the banking regulators, has been squarely within risk management, which is within the agency's purview. Also here we're talking about OCC guidance, so that's not a rule and that's not binding. So I don't think that would be impacted by the decision. The SEC's proposal, yes, it's on climate disclosure that was referenced on the earlier panel. I think there's a possibility that could be challenged under this new doctrine, and kind of remains to be seen how the doctrine would be applied in that situation.
Great. Final thoughts. I'll start with you, Jonathan. You had spoken about the OCC guidance. Anything that you can share or preview with us, or at least provide us some tidbits that we can expect in the future, and how you're coordinating with other agencies, because we saw a very similar proposal from the FDIC. Anticipate probably a similar one from the Fed soon. So if you could speak to the coordination that's going on and anything else you can preview. Yeah,
happy to, Tiffany. We're continuing to work really closely with the other agencies as we have done all along. This remains finalization of the risk management principles remains a priority of the acting controller. So we're pushing forward as fast as we can on that. I talk with my counterparts at the Federal Reserve and the FDIC frequently. Talked with them this morning, for example. It's a very collaborative approach to this. We're very well aligned And I think we're, with some of the things that have fallen into place recently, I think we'll be in a position where we can move forward. And then, the interagency collaboration, as we talked about earlier, is not just between the FBAs, but also with the market regulators and the other FSOC agents. There's a lot of work going on, as Nellie mentioned, at the FSOC as well. So I think really good momentum and focus.
Great. Mary, as Bank of America works with both private sector and public sector partners to help manage climate-related financial risk, what do you think would be helpful when it comes to working with these groups as it relates to this risk? And how can policy regulators be supportive to you?
I mean, I would say the thing that we found most helpful is, again, policymakers, regulators actually kind of sharing their plans and laying out draft principles for comment. Even disclose what the SEC put out there is incredibly helpful, because it helps us to start to at least understand where we're moving towards. It helps us, frankly, even share with our clients and talk to them about what we're seeing. And if they haven't started to think about it, that actually helps them to start to think about what they might need to do to comply. And frankly, again, with the data challenge, having consistency and kind of common set of information coming to us from our clients, and even from our peer across the industry, that's incredibly helpful from a risk management perspective. And so that's the thing that we find just very, very helpful.
Great. Well, we're at time. Thank you all to our panelists. Please help me a round of applause. We really appreciate your insight.